Fed will come in and actually do a bigger move, and in conjunction with 225 basis point moves, because it has to. And the Fed's book is losing money too. The Fed is hemorrhaging money because it has to repatriate money from the banks to the Treasury Department, and it's been in a deficit this whole time. So Powell's been a very bad manager. China actually holds all of the cards, but they're producing 80 to 90%, depending on which metal and where you're looking, of the processing capacity, which means if China ever decides not to allow its processed rare earths to leave the country, it stops the world.
Before we get started, this isn't financial advice. Know your risk tolerance, do your own due diligence, and make sure you speak to a financial advisor. Okay, let's get into it. Welcome back to another pod. Today's guest is one of the most fearless and forward-thinking voices in global finance and geopolitics, a best-selling author, renowned speaker, and former Wall Street insider. She's dedicated her career to uncovering the hidden forces driving our economic future. After years at the highest levels of finance, including as a managing director at Goldman Sachs, she's become a powerful critic of the system. Her most recent book, Permanent Distortion: How the Financial Markets Abandoned the Real Economy Forever, is a must-read for anyone trying to make sense of the widening gap between Wall Street and Mainstreet. Her earlier work, Collusion: How Central Banks Rigged the World, takes readers inside the secretive post-crisis coordination that reshaped the global economy. She's advised policymakers, appeared across major media, and earned the respect of investors, thinkers, and truth seekers around the world. Today, we'll discuss all things precious metals, the rising risk of a U.S. sovereign debt crisis, and the sticky inflation that continues to hollow out the middle class, and the AI bubble versus the real economy. Nomi Prins, it's a privilege to have you on. Welcome to the pod.
Thank you so much. I'm thrilled to be here.
So let's start with the gold and silver. I saw your piece not just a few days ago talking about the consolidation. Gold is up again. It's relentless. How do you see the gold market as it stands today?
Yeah, it's interesting because we have seen this consolidation sort of since the highs in mid to the third week of April, around the 3,300 per ounce region, and now of course we're popping up around 3,400 in the last couple of days. And the reason gold consolidated, but the bigger reason why it's going to continue to outperform the S&P and to continue to rally, is that it has so many factors driving its current momentum, and they are global and they are not going away. So to recap, we've got central bank buying. We've got the seventh consecutive month in a row of the People's Bank of China. I remember meeting with them back in the 90s when I was at Lehman. I mean, they've certainly come a long way in their evolution of their reserves, and the evolution today is gold. And it's not just China, of course. It's Eastern Europe. It's the BRICS countries. We have buying that is going on as a diversifier to the US dollar, as a geopolitical diversifier to US and Western policy, and as a consolidative reserve asset for central banks to do their own trade with each other around the world outside of the sort of post-Bretton Woods arena. And that's going to continue. And in addition to that, we've got physical gold becoming more and more necessary as a diversifier and as an investment class throughout private equity, private investors, sovereign funds, national funds, insurance companies throughout the world, because of its stability and because of its diversification properties in an uncertain world. Those things are not going to go away either. And that's just basically some of the tailwinds of gold. And then more specifically, we have momentum buyers coming in and recognizing it for the necessary asset class it is, and expanding portfolio percentages in gold. And that is actually just starting, particularly in the West. So there's a lot of stuff going on. So that consolidation sort of period to me was just an opportunity for those that are already in to add to their positions, for those aren't to get in. It's not over. And we continue to forecast gold at 4,000 at the turn of this year and 5,000 at the turn of next year, not because they're round numbers, but because that's where we're going, given what's going on. And we also are about to push into a lack of supply to basically complement this growing demand. So we will, I think, also see miners start to perk up. Some have done very, very well. Some haven't yet. You have to be selective. But all that's going on in gold as the Fed, sets out for its next FOMC meeting. Almost
no kidding.
the background of gold, really.
Yeah. You talked about exploration. I want you to expand on that. The supply crunch facing gold. Exploration budgets actually declined in 2024. You recently wrote about that. When are you expecting that to reverse?
Yeah, it's really interesting. And I think one of the reasons that they did pull back in 2024 was interest rates are still high, which means funding costs, capital expansion costs are still comparatively high relative to how quickly gold was moving. So even if some of these junior and sort of midstream miners were involved in viable assets, viable mines, viable so production timelines, there was a funding issue in that rates had to and still have to come down more in long-term funding, I think, to really incentivize some of the cash that's on the sides with some of these miners. The ones obviously with cash are better positioned, and the ones that are trying to still raise additional funds for additional explorations or the next part of their cycle. So we saw that kind of uncertainty tie into the junior miners market. That said, we've also seen big miners like Agnico completely move lockstep with gold, completely outperform because they had all their funding in place. They're big. They had the cash on their balance sheet, and that's going to drag the better junior miners up as well. That outperformance and that continued outperformance of some of the bigger miners. So I see the miners that are in jurisdictions that in particular meet high quality asset standards as they are laid out by Basel III, because that tier of accords is going to influence how the financial players purchase gold and what kind of gold they purchase. And there are miners that are positioned to really fulfill that type of demand at the higher quality, more neutral jurisdictions, more transparent operations than others. And those will be the ones that we're looking at that will outperform.
What are your top 3 or 4 jurisdictions today that you like?
Well, obviously Canada is a great jurisdiction because it's Canada.
Yeah. Nothing exciting ever happens here, right?
Nothing exciting ever happens in Canada. No, but I mean that's kind of a number one jurisdiction. I mean, so is Australia, Canada. These are just very neutral jurisdictions. But so are parts of Central and South America. So are parts of Brazil, so are parts of Central America, because we have the relationships, the U.S. in particular, the West in particular, has the relationships there to ensure that there's no sort of skirmish that can necessarily stop a mine production or a mine timeline.
Are there a few states in the U.S. that you like, that you favor?
Well, there's always the West Coast.
Nevada,
there's Nevada, Colorado. There's other mining going on in Utah. These are areas where the jurisdictions are also positive from a permit and regulatory standpoint as well, and not just for gold. I mean, for uranium, for rare earths, for other types of asset, for silver as well, where I think we're going to be seeing more U.S. supply, and also in conjunction with our Canadian friends, miners as well.
You touched on the juniors lagging, right? And some of the seniors typically lead, but then the juniors kind of come in and outperform. We haven't seen that yet. You've got this $4,000 target. When do you think the juniors and that, the money really starts to kind of flow in to lift the whole sector?
Yeah, I think that the money is going to start flowing in the second half of this year. And that's because of a number of things. One is the Fed. Part of the reason for the uncertainty around the financing aspects and just in general, the expense that could be in the long end of the U.S. curve is that the U.S. curve has basically steepened. So the 10-year and the 30-year remain quite high relative to the Fed having reduced rates in the short end by 100 basis points in 2024. They have not reduced rates this year yet. Powell keeps tiptoeing around that and sort of dogmatically attaching himself to inflation with a above 2% handle, even though CPI is at 2.8% annual. It's not awful. It's certainly better than it's been in the past. But these are the things that are under Fed operation, even though the macro economy and the economy of the U.S. is is weakening. We did have a negative GDP print last quarter. We are having more jobless claims come in. Our unemployment figures have not, decreased. And so there are weaknesses in the fabric of the U.S. economy the Fed isn't really focused on, as well as in the banking system, because of rates being higher, among other things, at the high end of the curve. And then there's U.S. debt, which is astronomical, at 37 trillion almost, and that is impeding just U.S. growth. And the budget process is going to basically add on to that debt, and that debt's expensive. So going back to junior miners, kind of in the scheme of these bigger picture movements, I think they're waiting for a move this year from the Fed to coincide with the consolidation and now again appreciation of gold this year. And again, I think gold's going to continue to zoom up in the second half of the year after this period of consolidation because of all these factors. And I think that this leg, and then you tie in the fact that gold is high and the sort of mid-tier and big-tier miners are out hunting for assets as well. So there's going to be bids in the market for the junior miners who have the permits in place, who have the good jurisdictions, who have the relationships. Mining's a relationship business to, potentially do something with the bigger miners who have benefited from already the higher levels of gold and they're already producing mines.
Yeah. Their free cash flows are just exploding. So really, there's this sort of switch, that easy money. Once people kind of see, okay, we're going back to kind of easing, at that point, you're going to see a lot of new money sort of come in. I did see that institutions, this huge 75 billion came into the space, I think last quarter. Yeah. Which is the first big reversal, which was huge. We'll put a chart up of that.
Yeah, that's a really good point. You have additional buyer classes coming in as well, right?
Yeah. I mean, when I think about gold, and the central banks have been buying for years, what's really at the heart of the demand? Is it the U.S.? Is it just globally people are kind of losing confidence as the U.S. inches toward, an inevitable sovereign debt crisis? Is that what you think is the underlying force?
I think it's broader than that. It's one force. I mean, certainly looking at whether you want to bet in the U.S. Treasury market or put your own economy's future into investing in the U.S. economy, which is very, very debt laden, versus putting it in gold, which is more objective as an asset, which is physical and real as an asset, and which is detached from U.S. policy, not just from the standpoint of debt, but I mean just all of U.S. policy as the globe continues to polarize into the BRICS, China-centric trade relationships. And that includes some of Europe. I mean, Europe is definitely diversifying its trade relationships, not least because of the latest round of tariffs and tariff battles from this administration. But they're going in that direction anyway, to sort of diversify and work more with China, work with Southeast Asia, basically those relationships. And they require an objective sort of currency peg. And even though that doesn't necessarily mean a gold new standard, it does mean that gold can be that additional stability, almost physical currency behind any trade deals that happen with local currencies between countries. And so what we're seeing is the more that, oil deals, for example, are directly between the Middle East and China, or the Middle East and Russia, or whatever it might be, they require some sort of an objective kind of piece. And the objective piece is gold. I mean, it's had the long-term stability, built in, and it has the tier one asset class from a capital standpoint for banks. So if you're a central bank and your banks can basically buy gold as for credit purposes, risk purposes, not yet for liquidity purposes, that hasn't been agreed upon yet by regulators throughout the world. But gold means something for the stability of their own financial systems as well. And so there's a chain up from domestic finance, domestic trade partnerships, and international need for objectivity that is also driving gold. And that's not going to change. Every time the U.S. and China has a conversation about trade, it benefits gold. It doesn't matter where that conversation goes, because there's the long strategy that China's playing, there's a short-term strategy that the U.S. is and has been playing from the standpoint of physical assets, and gold is a recipient of any conversation about that, because it basically leads into long-term geopolitical strategy.
Yeah, no, that makes sense. I mean, how long can the U.S. finance its debt at these levels, right? With the Treasury, with the interest rates where they are, I just feel like, man, the Fed has to cut sooner rather than later. What's your timeline on that? Like, are you expecting 2 or 3 cuts this year?
I'm expecting 100 basis points this year, and that will probably look like somewhere between 2 and 4 cuts, like we saw last year. So at some point, I believe there's going to be a very negative print, not necessarily in GDP, but perhaps on the employment side, or perhaps a combination. CPI will be much, sort of more consistent in the closer to 2 versus 3 range, even though it still has a 2 handle right now. And the Fed will come in and actually do a bigger move, and in conjunction with 225 basis point moves, because it has to. I mean, that's the reality. The reality is that the moves that happened last year have benefited, the front end of the curve, but they haven't made a dent. In fact, they've been sort of counterproductive to the long end, which is where those costs come in. So if you're the White House, and every single time Washington, wakes up and has to turn on its lights, the lights include paying nearly $1 trillion worth of interest on a growing mound of debt. And most of that interest is on long-term treasury bonds. And the long-term treasury bonds have not had their yields diminished. So I also think that the Fed's going to stop its, it basically did stop its QT. It's down to like 25 billion a month, which is basically really pocket change on a $6.8 trillion book of assets that the Fed has. It means nothing. And I think pivoting to a QE is also a likely occurrence that we will see in the second half of the year as growth slows, as these interest payments they rise. They're already high. And the Fed's book is losing money too. The Fed is hemorrhaging money because it has to repatriate money from the banks to the Treasury Department, and it's been in a deficit this whole time. So Powell's been a very bad manager of the Fed's own book.
Yeah. You talked about the front end, the long end, and it backfired last year. What makes you think that if they reduce rates 100 basis points, that the rest of the world is sort of going to go along and agree to pay lower rates for the 10-year, the 30-year Treasury bonds that they need to sell?
That's a really good question. I think they will have to do that move in conjunction with some form of QE or some other form of bond purchasing. And it's going to coincide with some event or data point that will allow Jerome Powell to feel it's okay. And it doesn't sort of go against their anti-inflation stance, because the gap between short end and long end yields it's a fiscal problem. It's a real problem towards operating the country.
Yeah, no, that makes sense. So, I mean, he'll kind of use something to make sure that everyone knows, well, the Fed is going to be stepping in as the lead buyer now to try to drive that demand and just get everyone to go along.
Right.
Interesting. So do you see inflation then, I guess, continuing to come down and soften, like towards that 2 handle or even below?
Yeah, I see it in the 2 handle. I don't really see it below the 2 handle unless there's a particularly bad quarter. But I actually see things like oil prices actually going up on some of the tensions that have been around. I personally believe that that OPEC Plus has tried to capture market share by increasing production, and in conjunction with the White House's stance on drilling. But the reality is that the words about drilling and the activity of drilling are actually not the same thing in the United States, and the oil companies are very upset by oil at these prices. And so I think between that and the fact that there's market share gathering at lower prices from the Middle East through the BRICS Plus and outward, that there will be events that will come together that will require oil prices to be higher monetarily for everyone involved, but also because of geopolitical events. You still have the Ukraine-Russia war, which is still on edge for them, obviously. Ukraine is also for Europe. You still have Middle East tensions. A lot of these tensions are still baked in. It's just that the producers have been able to sort of contain prices. But I just don't see that lasting. And so therefore, I think some of the inflation will start to peak up, but still stay in that 2 point whatever range, not necessarily go much up past 3 unless there's like a major event, major spike. But I think we're set in this range of, so the 2.5 level.
Yeah, that sort of even 3% is like the new 2% for a lot of people. But
Right.
do you think we're in an environment of stagflation, and do you think it's going to persist? Like it feels like it for me, for sure.
Yeah, no, I totally agree with you. Because if we take inflation even at these levels and, add or subtract a half a percentage point on any quarter, on any annual to annual basis at this point, relative to growth, we're flat. I mean, that's just the numerical fact. And that doesn't include, the fact that the Mainstreet buyer of groceries feels really strained every time they walk into a supermarket. I don't walk into supermarkets in Canada, but I do know that every time I go into the one in Hollywood, I have conversations. I'm very much boots on the ground, whether it's in a mine or in a supermarket. I have conversations with the checkout people. I have conversations with people around me. And literally every single one is, I came in here to buy $20 worth of things and it's now $70 in my cart. Or what's in my cart used to be $100 and now it's $200. I mean, there are these pressures that are building up anyway. And that ultimately has a depletive effect on the economy, because it means that consumers have to basically take on more debt. We're already at historic highs on debt to make ends meet, from utilities to rent to groceries and so forth. And so they start cutting things out because that's natural to protect their own finances, but they're still paying high interest costs on whatever they've taken out credit for. And the grocery bills are high. And so this is going to keep the consumer is a big part of U.S. GDP. That's going to keep that number kind of depressed. And so not necessarily depression, but that number depressed relative to inflation. And so, stagflation is definitely what we're dealing with for the foreseeable future.
Yeah. And I can tell you in Canada, it's the exact same. I mean, the huge surges, 50%, 100%, we've seen in the last 4 or 5 years, prices just have not come down. So, the wage growth has not kept up. How are you navigating through stagflation? Like, what are you, telling your clients? Obviously, you're staying allocated to hard assets and, things that are going to benefit from the inflation. But how do you navigate that, economy for the next, 3, 5, 6, 10 years?
Yeah, I mean, it's a great question too. We do on an investment side, most of our mile portfolio for our investors is hard assets, and it's the gamut from gold to silver to copper to uranium and to rare earths as a speculative asset class. And that's, although it's not speculative, it's just speculative for people who don't know about it, and also infrastructure related or control of energy-related types of companies that basically have to continue to grow and produce, because even though, for example, we're very slow in the U.S. on updating our power grid, it's still a necessity for AI data centers and so forth. So there's a lot of background logistical infrastructure necessities that are getting funded by the budget, and that do have contracts with some big and smaller, by just virtue of contracting downstream, players that we also have in our portfolio. But all of that also connects to real. So those companies are requiring copper and silver and so forth to basically build what they build, and they are long term, and they're long term globally. So we also have a section of our portfolio dedicated to sort of global players as well in both Europe and we had a bunch in Europe actually that we have from the standpoint of energy transformations and so forth. We've got that sort of
expand on that. I know
Australia and other
a lot of people are expecting, like, Europe's really been pushing the renewables for years. Are there some big projects there that you like? Like, you like quite a bit of exposure to Europe right now?
We don't have a lot, but we certainly have had some good names, both on the defense side in Europe. So from the standpoint of the exposure of that sort of pivot point through NATO to some of the budgets that have increased both in the UK and throughout the EU and Eastern Europe to support countries vis-a-vis the Russia-Ukraine conflict. So we've actually had some names in there that have done, extremely well on the back of, that kind of defense infrastructure growth and the budgets that are coming in there, as well as on the energy side. Certainly, there are companies that are really on the cusp of both the renewable aspects of energy, but also, again, grid updating and the expansion of lines to to nuclear or new nuclear facilities and so forth. So we try to look at ones that are more diversified sort of throughout the energy spectrum. And in general, internationally, those are the ones that we think have value. And in the United States, we actually like looking at energy companies as well. So we sort of augment our hard assets with energy infrastructure and defense. We're pretty much not in AI or sort of official tech, although we look for AI efficiencies and technological efficiencies in all of the companies that we select.
You utilize AI, but you're not directly invested in it.
Right. We don't have NVIDIA in our portfolio, for example.
Right. Yeah. No, you're not buying it at $150 right now. Yeah, that's a perfect storm in Europe. I mean, with the US kind of saying, hey, you're on your own, and Germany and Austria and these countries just exploding their budgets for defense.
Right.
That's a nice place to be. You mentioned copper, gold and silver ripping, platinum, palladium ripping. Copper, hasn't. And it's kind of remained pretty range bound and almost muted. That tells me the economy is not as strong as people maybe want to believe. What are your thoughts on the price of copper and just kind of the supply demand environment there?
Yeah, that's a great question too, because the supply demand is such that the future requirements for copper, for these grid technologies, for basically transforming energy globally, and that's in the East, that's in the West, that's everywhere, as copper is still required for all of those projects. And there is a dearth of supply relative to future demand. It's just that right now that hasn't sort of caught up. And so we kind of see this range bound sort of under $5 level for copper, where I was actually asked this question recently. I rank gold, silver, and copper. And I would like to say this year that I think copper is going to break out, but I mean, I just don't. We have copper names in our portfolio, again, in good jurisdictions that have good, solid mining capacity, or already operating and already producing and already processing, and their copper is being used. And the contracts are there, but it's I don't see that breakout this year because of exactly what you said. There are still muted economic factors throughout the world, and even though there are long-term projects that require real assets on the energy side and on the sort of just growth side from an infrastructure and defense perspective, the sort of demand for copper today has not accelerated because of the expectation that this economic sort of muted period is going to continue. But like with silver, silver suffered from this problem as well before it started to break out to 13-year highs just recently. And it was lagging gold, and it was sort of, silver is the second cousin of gold. Yes, it's more volatile. It's good. And I felt that silver, I've spoken about how silver does have this tremendous upside. And I said the same thing I'm saying now about copper, about silver 6 months or so ago, which is that you still have to be invested in it. It's still very much a part of the world economy and world growth, and just where we're at in terms of humanity. But at the same time, its headwinds are those economic stories. And silver had them and has broken through them, because silver is obviously also an industrial use metal, but it also has a bit of that sort of gold reserve asset cachet that it can draw upon also. But it wasn't, and now it is. And copper doesn't have that, right? Copper is not going to be a reserve asset. It doesn't have that other reason to drive it upward, but it definitely has the demand supply gap. It definitely is required for all the long-term growth that is on deck and that will, increase globally. But it's just suffering from that. Well, where is the growth today from the standpoint of investors, from the standpoint of where the market is paying attention?
Great summary. Yeah, great summarize. Yeah, silver was getting, it wasn't getting any love because people were just focusing on the industrial uses being muted, and exactly now the monetary metal side is taking it higher. I want to talk about critical minerals for a moment. Obviously Trump and China, every day it's a new story. We're going to get the metals. They're going to send the metals. It's funny, Canada has a few little metals like indium and different things that we send to the US, and vanadium, titanium. There's some senators down in Arkansas, pounding the table saying we have to prioritize these metals. Gallium, is another big one that they've been focusing on. What do you like in that space, and how do you see that side of mining playing out here in the next 5-10 years?
Yeah, I mean, gallium, of course, necessary and on the nuclear side, and definitely a lot of those metals necessary from the standpoint of magnets, and the standpoint of defense and missile systems, and I mean, just even the conversation we're having on this on this computer platform. I mean, there are obvious needs for rare earths, and the thing that's going on between the U.S. and China is super interesting because China actually holds all of the cards right now. I mean, for the most part, you were sitting down at like, yeah, a blackjack table, and it was
Come
like,
on, we don't have
right,
the
you were
royal
sitting at
flush.
China's, or yes, or at a poker table. You know, you're
Yeah.
basically looking at, it's sort of betting on China's long game, and that is because of how they have consolidated and continue to grow their hold on the processing of rare earths. You know, they might only have 50, 60% access in terms of the actual asset, but they're producing 80 to 90%, depending on, which metal and where you're looking of the processing capacity, which means if China ever decides not to allow its processed rare earths to leave the country, it stops the world, right? And there's a lot of what's needed in terms of current geopolitical, national defense, energy, all of it. And so the conversations between Trump and Xi, or between the White House and Beijing, are really interesting from that standpoint, because we've certainly had rare earth tariffs put in place, but China has had more put in place. China basically in April was like, look, we're going to just tariff or basically stop, 7 major rare earths from hitting U.S. shores. And when they said stop, what they meant was more permits were required, more regulations are in place. Like, it was finesse, but that was basically what the bottom line was. And just a week or so ago, they said, okay, but our partners, our partners that we like in Europe, our partners that we like in Southeast Asia, we're going to alleviate some of these barriers. So we're going to make it easier for rare earths to flow to our partners. Which is what they did. And so the White House basically is looking at this and saying, all right, well, you cannot just control rare earths, you can control which countries actually utilize them to build things that we want to build with them. So there is an entire, geopolitical sort of ecosystem just around rare earths that a lot of, that China basically holds the cards for. So the U.S. has to basically deal here. The U.S. basically has to, I would capitulate to China in some way. That's not the word that the White House would use. That might not be what it looks like in practice, but that's what has to happen in order for us to do that. But at the same time, what needs to happen, and there were executive orders that came from the White House on this very thing, is that the U.S. has to secure its own larger supply and allied supply of rare earths, allied being whether that is in Brazil, whether that's in Australia, Canada, augmenting the bit of rare earths that are in the U.S., and processing capabilities. Right now, there's only one U.S. miner that can process, basically separate rare earth in their combined chemical form into usable, individualized rare earths. That's not going to help make a dent in the processing strength that China has, and that by extension China is giving to the partners it wants to trade with. So there's all these other things that happen in those conversations. So any of this can change on any given day with respect to the U.S. and China on the conversation around criticals. But what it means ultimately is that the jurisdictions, again, with access to rare earths, with plans in place and permits in place and partnerships in place for processing capabilities, are going to be the ones that are going to accelerate on the Western side of the equation for the U.S. In particular in the rare earth space. And those are the ones that they're long-term investments because of all of the sort of noise back and forth. But these are the things that we're looking at in terms of investment. So whether it's titanium or gallium or dysprosium, it's all of these metals, rare earth elements that are needed for any form of magnetic capabilities.
Yeah. Canada has created an infrastructure fund to try to fast track some of these projects. I saw something in the US, I don't know if it was related to energy or critical minerals, where Trump had like a 14-day environmental approval process. Have you heard about that, or do you know anything about that?
I thought it was 28-day, but
Okay.
I mean, there was a 28-day permit process where he basically looked to fast track well, it was in an executive order a month and a half ago, where he basically said, we need to fast track permits and the regulatory process. And then a couple of weeks ago on the NRC, the Nuclear Regulatory Commission, he basically had an executive order to fast track some of their regulatory processes, and that kind of gave a bump to uranium producers in the United States and their partners around the world. Actually, I mean, Cameco in Canada got a bump from that as well. Of course, it's doing quite well. It's like Agnico in the uranium space in terms of that, sort of powerhouse in that space. But I think there'll be more of those. Rare earths critical processing capabilities are definitely on the White House radar. I mean, a lot of things come out of the White House and out of Washington, but this is an area where there is bipartisan support, where there is a real focus on the need from the standpoint of the congressional side as well as the executive branch. And that's going to continue. So I think we're going to continue to see more pieces of legislation as well as executive orders that will accelerate this sort of extraction, mining, and processing of critical minerals.
Okay, so I know you're a bull on the metals, particularly gold, silver, for the latter half of this year and into the future. Can we talk about the U.S. markets just sort of broadly? You're not into AI or tech, it sounds like that much. When you kind of zoom out, we're approaching nominal highs here again on the S&P. This has been kind of the semis have sort of led this rally, the NASDAQ. It's been very, AI tech driven for years and years. Do you see it sputtering out? How do you see the S&P and the NASDAQ performing, for the remainder of the year and into next year?
Well, if we do get, which I believe we will, some sort of a Fed movement to reduce rates, because even in the short end, when you reduce rates, that helps the markets. Short-term funds sort of flying into stocks, and that helps on the tech side and AI side because there's a lot of funding that happens on every level of the curve, and that will move both the NASDAQ and the SP 500 up. And of course, the headwind on that side will be that economic growth itself is basically hampered by debt from the consumer up to the national level, and that's going to mean and that's basically what I wrote about in Permanent Distortion. The entire book was about that disconnect between the real economy and the financial economy. The financial economy is driven by shorter-term cheap money, and that impacts certain companies in the financial markets, of course, that require that, whereas the real economy tends to lag in terms of growth. And then you throw inflation in there, you get stagflation. That's basically that disconnect. That's that permanent distortion. But if we start to see the Fed recognizing this and cutting rates or doing something on the QE side, that's going to cheapen funding. That will give a boost to the markets. Of course, every single conversation about trade that goes wrong will have a damaging effect on the market. So I think we will see this volatility throughout the year. I think the S&P outperforms the NASDAQ towards the end of the year because of those two sides, the polarity of uncertainty around tariffs or geopolitical events or whatever. And then on the other side, slow down economic growth, inflation not being horrendous, and the Fed coming in and doing something with rates or bonds. So even as debt continues to increase, no matter what. And I say that because the NASDAQ's just more tech heavy, not because the SP 500 obviously has the big tech companies in it as well, but just on balance, I think that's those companies in the SP 500 that are more fundamental to infrastructure, to defense, to recalibrating the energy system, which the White House declared an emergency. I think those plus real things will be where to invest, and that will outperform.
We'll put a link to Permanent Distortion below, but I just want you to expand on that a little bit because, people do feel like they're sort of in this box, and you summed it up there, but I just want you to expand on it, right? I mean, those who have assets have benefited from the low rates. Those who haven't have been living in this world of stagflation where everything gets more expensive and they fall further behind every year. How, do people navigate that? Obviously, if you have assets, you've done okay, you've done great. But if you don't, is there a middle ground there, or how should people navigate that? Yeah, and do you expect that? I mean, it's permanent, so you don't expect that to change anytime soon. Like those are sort of the rules of the game. Yeah, it's just they're going to keep kicking it's going to keep going, right?
Yeah, I mean, we're still in a world where central banks support the markets, even if that's not the conversation on any given day. I mean, even though the Fed balance sheet is just 6 point whatever trillion instead of the 9 that it was in the wake of COVID, it's still double or, it's still, well, got to double. It's still significantly higher than the 3.9 it was going into COVID, and so trillion. So we're still in this world where central banks are to an extent supporting the markets, and what that means is that the cost of money, even though it's higher than it's been historically, and it has all the impacts on debt, which we talked about, it's still a carrot to markets relative to the real economy, which tends to operate more on the longer end of the curve. So the longer end of the curve both increases expenses. It makes sort of refinancing mortgages more complicated. So it's made the housing market go down. And one could say, I'd say, it maybe needed the correction. But the reasons for the correction are that interest rates are too high for refinancing mortgages or to get a new mortgage. And so that's a problem in terms of growing up, sort of some economic ladder as a regular person. In terms of the investment side and looking at their longer term portfolios, if they've been 401ks in the stock market, they're still doing okay, for the longer term. But inflation is obviously eating into that, as are these higher costs to finance new things. So you do have to, as a real, anybody, is continue to invest in real assets that have held their value and that are part of the slow but steady transformation of infrastructure and energy globally. That still has to be a thing. And you can also be in tech and everything else, because that is going to be impacted by lower rates in the short end and Fed cuts in the short end. And we don't particularly focus on that as much here because we look at, again, the combination of AI and tech into those other forms of assets. But those are important things for our investors, and also reducing your debt load. I mean, the reality is, as hard as it might be, because people are paying more for everyday things. So it's very hard to say, all right, we'll also try to reduce your debt load on your credit cards, because you're basically just making ends meet. And it is a really tough squeeze situation to be in. But even so, if there's anything that can be done to reduce your growing debt load and your compounding debt load in any capacity, I mean, even if it's $100 a month that you thought you didn't have because it just went into your grocery, bill or whatever, those are very important tweaks in this period to make, just to create some sort of a longer term balance on the side of debt relative to investments.
Let's come back to precious metals and kind of bring it home. Let's come back to sort of the catalyst that you see driving gold higher in 2025.
Yeah. So again, all of this uncertainty and all of this recalibration of countries and central banks and sovereign funds and their own seeking of a more equal platform on the financial stage are all drivers of gold, because gold is that objective asset that they can buy and hold and use as collateral, even if it's not in an official standard, in trade agreements, in payment systems. There's a really interesting development that's going on the payment system side, which is that in the wake of the Russian invasion of Ukraine and the U.S. sort of kicking Russia out of SWIFT, which is the U.S.-dominated payment system where contracts for payment across countries get validated, and that's its benefit. That the Chinese have a sort of competitor payment system that has been growing called CIPS. We've written about this on print sites on our Substack. That is basically growing to encompass more countries and more banks from more countries into their system in whatever currencies they may be trading in. They don't have to trade in the Chinese one. Brazil has a payment system that directs that, basically a digital currency and a payment system around it that they're developing as well. And so as these payment systems develop, the anchor for even cross-currency trade through them is still objectively gold. And so the more those payment systems enable countries to take out the US and settle trades and settle financial transactions without the dollar and without SWIFT, the more that they will want to increase that objective asset. That is gold. That's continuing as well. That's the leverage that's happening as geopolitics sort of split the world into these two poles. And that's going to catalyze gold as well. Very maybe quietly in the backdrop. It's not what every investor is looking at, but it's that extra carrot that's coming in to catalyze gold, as well as, and we talked about this a little bit in the beginning, just the fact that that funds and asset managers are increasing their gold percentage allocations in their own portfolios. And what that means is that they have to ensure that the money that they are managing is invested in more gold-related assets and in more physical gold. And that's going to, you do that across the country, across the world, that has the effect of increasing the demand and therefore the price for gold and also the relevant gold miners. And I think that's all happening. We're seeing that in the numbers, and we're seeing that in the conversations that are happening. I just quick personal anecdote. I went to my dry cleaners and who was next to a gold and silver broker that has been, they've been next to each other for like decades, so like they're besties. and I just wanted to interview him to just look at trends and just kind of a walk in business. And she's like, yeah, no, tell him I sent you, blah blah blah. I get all my stuff. And he does gold bars, the whole thing. And I talked to this guy who's been he's in 29 years in the business. And he's just like, I can't, I had to hire like 2 other people just to deal with like just retail individual flow who are coming in to get involved in some way, not just in silver.
That's a change though, Nomi, because, in 23 and 24, retail were selling their gold as it was moving up.
Yes.
Right. So, I mean, the activity is changing, but this guy's telling you that they're buying now.
They're buying now, right? People are still, coming in with their gold, but he's like, they are buying now, and that is interesting because it's that on the ground. He's one little, storefront.
Oh yeah.
But you add that up,
you do. Oh, it adds up, and I mean, you've seen the Costco. They've been selling the gold, and where was that 5 years ago, right? So
and no one's selling it back to Costco. No one's like, no. I'm going to return the gold. No one's doing that, right? It's a one-way thing. Right.
No, because it's higher every month. So why would they?
Yeah.
You mentioned CIPS. I read about that 6 months ago or a year ago. Have you seen anything lately, like in terms of adoption and more countries and more trade using that as a backstop? Has anything like big happened there in the last 3 months that maybe our viewers are unaware of?
They continue to sign up more financial institutions to be involved in it. So there has been an increase in the financial institution sign up, which has been their strategy to basically get more national sort of banks and funds to get engaged and to prototype their use of the system. So they've been developing that sort of base infrastructure of it in the last few months.
Yeah. Okay. And I mean, the trust in the U.S. has always been sort of two-pronged between this great democracy and the military might. And there just hasn't been that, for China, right? People just don't seem to trust them, the yuan, right? So do you think part of their purpose for just accumulating is just to sort of build that underlying trust in the yuan to get more and more countries and institutions like signing up for CIPS? You think if they just see a big enough hoard of gold that they'll just start trusting the Chinese?
That's really interesting. I think what it is gold creates this sort of friendship of a band. And so you have gold, we have gold. This isn't a U.S. dollar. It's not even a Chinese yuan. It's just gold, right? And we're as other countries buying it for our own purposes. You're buying it. We sort of get each other, and if it becomes the sort of backdrop for a financial payment system or any kind of system, then we're already sort of engaged. Where I think there's trust building for China is it's a trust of requirement. I mean, it's a trust of we go back to the rare earths part of the conversation. It's like we actually need certain activities and certain products and certain processed products from China, and if China needs for us to be engaged in their payment system, us meaning any other country that's trading with China in their payment system in order to facilitate a sort of tighter financial arrangements, then we're going to consider that. It's an option for other countries, especially because the U.S. has been very unclear in terms of, where tariffs are going to wind up and where in the, sort of downstream through upstream process they're going to take effect. And so that uncertainty coupled with the debt might mean that the U.S., has that old democracy or current democracy sort of component, but it also has a lot of things that really mute trust as well right now. And countries in general are just, and that's where this rebalancing is happening. It's picking options, really. I mean, the U.S. and China are options to every other country. That's really what's going on here. And when you buy an option, you weigh all the elements: the payment system, the currency, the longevity, the trust, the uncertainty, the debt, the growth, the rare earths, the assets, right? And that's, I think what's happening right now is we're in a period of just international reevaluation of countries in terms of what they require nationally and what they require in their circle of friends and what they require from even their adversaries that will make them viable and survive in the future, because at the end of the day, they're run by people that want to stay in power. That's just at the core basis, and there are needs that need to be met in terms of economics and assets to do that, and so that's where the world is right now. It's in this really this reevaluation period.
Absolutely, Nomi. Absolutely. I like to give our guests the final word or any final thoughts. Anything to focus on as we move forward in the markets?
Yeah, well, again, I think if you're not invested significantly in commodities and in real assets, there are just too many reasons driving them to not be. So whether that's gold, silver, still accumulating copper, it's going to take a minute to break out. Definitely uranium, as global support for that continues, and rare earths and other critical minerals. I mean, these are all things that should be part of everybody's portfolio, as well as a sort of international diversification of companies that build things, that actually make things with these products. So, taking it to the next level, as well as requiring the energy that they help to produce. So that's what I suggest. Also tune out some of the noise. I mean, I would suggest listening to sort of less instances of news around all of these things and maybe more composites. And of course, you can always check us out.
Where can our viewers find you? Yeah, where can we look you up?
Yeah, I mean, check us out at printsites.substack.com. We have a lot of complimentary content on all of these topics: the Fed, central banks, assets, the whole 9 yards, as well as model portfolios at different tiers for middle and larger cap companies, one tier, as well as for these emerging long-term opportunity small cap companies. And we're out there I'm out there all the time. I'm out there with hard hats at Mainstreet. I mean, we're not just doing this from a desk. It's really connecting the world to these portfolios. And so I encourage anyone to check us out.
Amazing. Well, thanks for coming on. I really enjoyed it.
Thank you so much for having me.